Steve Sosnick, Interactive Brokers Chief Strategist, joins us now. Steve, Sri was just setting up for us that we had that block trade from Morgan Stanley on Viacom CBS yesterday. Are you seeing more come through?
I think we are seeing a bit more in terms of drips and drabs, but I think the main bulk of it has been digested. We're just not seeing the kind of crazy activity that we saw on Friday, or as Sri mentioned, some of the trades that had been shopped over the weekend. As far as we can tell, those seem to have abated for now, but it's way too early to give a full all clear.
Steve, good morning. It's Guy. Is this a single fund problem? Is this an industry problem? I'm sure that this fund had similar positions to other funds, and while it probably had a little bit more leverage and therefore the margin calls came a little earlier, others are running with a lot of leverage as well.
That is the billion-dollar question, Guy. Who else has either similar positions, or I think the bigger question is, who else has a similar setup with their prime brokers? If I'm the prime broker right now, I'm asking the question, who do I have this kind of leverage, lines of leverage out with, and what can I do to reel them back in? And the other question would be, what behaviors did Archegos have that may or may not be appropriate to some of the other customers that a prime broker would have? And I think these are the sort of questions that take days to work out. And I'm sure that these risk departments are working assiduously to figure this out. But I think it's probably not a unique situation that you had a single family office with multiple prime brokers using leveraged exposure to get to get them many more times the capital put into play than one would think was even possible, but under normal standards.
Right, and that's what was really interesting, that it was multiple banks with multiple amounts of leverage, and that does seem quite unusual. I wondered if you could help us understand, as far as you know, what kind of swaps are we talking about, and why are some more exposed than others? That might also help us understand sort of what other hedge funds may have this kind of exposure.
Well, I don't know the specifics that they used, but what you could be doing here is, let's just say it's a total return swap. And so in this case, you've got a couple different situations. It's a private contract between the customer and his prime broker, and the terms are to use the fancy term of the industry, they're bespoke. But what you also have there is, because the shares are ultimately held by the prime brokers, they're in street name. They're not really disclosed in the way that you'd expect standard disclosure to be for a large institution. So when these trades were occurring on Friday, I'm sure I was not alone frantically hitting up the HDS page on Bloomberg going, who owns this stuff? And all I'd really come up with was Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, which we now know that they really were the holders of this, but that becomes the big problem.
Steve, so how do we deal with this? We're in a situation where we've had huge amounts of QE, we've got super low interest rates, people are gearing up because they need returns, and the money is available to be lent out. Yet if we're structuring this process using swaps, we don't have the regulatory disclosure that you would expect. Do we have visibility on where the leverage is, where the pockets are, where the problems could be? Let's assume the tide goes out. Like, what happens?
Again, your question is spot on, Guy. We don't know. I would hope that the banks know, but obviously they mismanage this one, because one of the problems is, if you have multiple prime brokers, do you really know what the other guy, what your customer's exposure is with the other brokers? Just as I think we sort of had the trials and tribulations about GameStop and the like, I think we need another set of fact-finding process here. And I think I would argue in many ways this is as critical, whereas the meme stock phenomenon involved individuals, so that's what gets Congress off the bench. I would think that you're going to have some real concerns at the SEC and other global financial regulators about what hidden time bombs, for lack of a better word, are hiding out there. Think about what happened with SoftBank in listed equity derivatives in the August-September period, and how a firm that big, tripped itself up, but it never did it in such a way because they were using listed derivatives that they could take down multiple banks. In this case, where the stuff is off the books, you don't really know what's out there, and that becomes a real issue. And I think that banks and their regulators are going to have some really serious conversations about what to do about this going forward.